Thanks for the very kind introduction. I don't know if I heard those many kind words when I was working directly or indirectly for you 25 years ago. I'm just teasing. It's a pleasure to be here. I'm definitely not the president of Latin America of Chevron. That would be probably pretty interesting and probably be a lot richer. But I do really have, I think, some interesting things to share with you around oil and gas activities, the leading indicators for those, and lots of interesting information that I think that hopefully will be useful to you that you can take back to your companies. And later this afternoon, I fully intend to go through the exhibition and look at all the interesting companies that are here and presenting their wares. Quest is known for its clarity, insight, and vision in providing cradle-to-grave market intelligence and data analytics to the industry worldwide. Forward-looking statements, information in the outlook presented herein are subject to change. Our research is also copyrighted, and terms of use and distribution are governed by subscription license agreements that we have with our clients. There's one thing I know that is certain, and that's uncertainty, and that changing market dynamics will certainly lead to more variation. Today we're going to review the international opportunities in what certainly is a challenging market. We all know too well that geopolitical forces, regulatory frameworks, and technologies shape oil and gas markets in many ways. Today we'll look at a market overview. Flying around the world, we'll look at some macro market observations, which I think are very pertinent to what we see and will see in the future, and that's natural gas supply and demand dynamics. And then we'll skip over to deepwater drilling and look at that on a global scale. There's lots of changes in that market, some good for the operators, some less favorable to the contractors near term. We'll look at some more leading indicators and drivers for those opportunities that you're pursuing as companies. And then finally, for our industry specifically, regional opportunities in much more detail. As referenced, the evolving landscape, technology has pushed widespread from blowout preventers to subsea boosting and multi-phase pumps, subsea gas compression, and other key equipment as well as software and sensors across the spectrum, in addition to fully automated drilling and much more. Companies such as the Schlumberger OneSubsea Cameron consolidation acquisition are driving a lot of this activity as well as their compatriots. Schlumberger CEO has indicated that he believes that the focus of our clients, the oil companies, are shifting to a cost per barrel as well as opposed to kind of centric around well cost. And this is probably more of a holistic approach relative to delivering turnkey services and full spectrum of services. Integrated delivery, standardization, scale, the scale you can deliver to, efficiencies, optimization, all the buzzwords we hear, but they're really more real, I think, in the current environment. There's a shifting contract model, perhaps, one that's been touted by Schlumberger, moving more towards pay per performance. If the suppliers are forced, if you will, to reduce cost, they're going to have to make it up on, performance bonuses and performance arrangements commercially, perhaps to be able to earn their margins and profitability. Heightened M&A activities and a drive to consolidation disrupts the playing field and alters the competitive landscape, as many of us are probably seeing now. It's survival of the fittest indeed. Before we dig into the detail of offshore projects a little bit later, let's look at a little bit around oil prices, the changing markets. Rest assured, however, that the current supply and demand imbalance and the lower commodity prices that we see will ultimately lead to global energy demand increasing. This is the simple law of economic supply and demand, whatever you want to call it. When? I certainly don't know, nor do many others. However, I hope to share some bright spots of the activity a little bit beyond the near term. back to oil prices, basically the consensus is, $50 to $65 a barrel, somewhere around the gray line and the green line. This is Brent, perhaps rising to 75 to 80 towards the end of the decade. As I say, really don't know. There's going to be spikes up and down relative to volatility. Again, lower prices for longer will tighten new supply additions, including LNG markets, which are very near-term oversupplied. However, I'm going to talk more about that later. There's something, there's a box down here, let's see. I'd like to diverge slightly for a few minutes, talking about global natural gas demand and supply, because I think it's very important to the projects that you will see now and into the future. And most of this analysis is looking at 20 years of activity, actual to present, and then forward to 2020. We'll see a commonality of a natural gas thread running through and affecting many of the projects, the dynamics of will that you're going to see. Worldwide gas demand by region. As discussed in IEA's midterm gas market report in the summer of 2015, this is their research and our analysis from it. Near term, of course, amid market uncertainty, lower oil prices are leading to slower gas production growth. Near term again, however, there's still growth. It's not negative. There's slower growth. Long term, the IEA is ultimately forecasting reacceleration of global gas demand. And amongst all the moving parts, with all the select caveats, there are many paths this could take. So let's look at some of these demand drivers. And then again, beyond 2020, there's another 10, 20 years of activity, and it becomes probably a little more bullish. Natural gas can provide enhanced energy security, as you all know. Israel, we'll mention them perhaps, they've messed with their regulatory framework, and now they're experiencing delays from that. Natural gas is a clean fuel, environmentally friendly, primary industrial feedstock, and its environmental benefits are well known. China is actually starting to show their concerns, we hear and see, via an environmental policy which is looking at switching away from coal. A move from coal for China is good for global gas demand. China's demand in red is projected to triple from 2000 to 2020, while Africa in yellow will grow nearly 40%. In the Middle East, total demand growth will nearly double from 2000, and in the period 2010 to 2020, it will rise 34%. OECD, Asia, Oceania in blue, namely Australia, New Zealand, Israel, and Japan, are projected to grow 24% over the period, the near-term period, 10 to 20. Yes, the IEA counts Israel and Asia. We do not, by the way. Non-OECD in green, India, Indonesia, Malaysia, Thailand, Pakistan are the countries in the area showing the most growth, but the region's demand is projected to expand 23%. In contrast, OECD Europe, light blue, is the only declining region by 2020, with the FSU, former Soviet Union, Putin, flat. A look at the natural gas demand by sector shows some interesting points. The power generation sector in blue is a key area of growth across the board, essentially, and in many regions, followed by industrial demand in orange, and the gray is residential commercial, which is less growth-based. The power generation segment globally is projected to nearly double at 2020 compared with the start of the period in 2000, while the industrial sector shows gains of nearly 50% over the comparable period. Notable growth regions include Mexico, where the power sector is driving 3/4 of their gas demand growth, as well as Africa, where gas demand will double, more than half of that from the power sector. And in Indonesia, growth is led from industrial, and combined with the power sector is a large increase of around 75%, using 2010 as a baseline. Now on to gas production or supply. In Africa, shown in gold, the continent's three major producers to 2020, Egypt, Algeria, and Nigeria, are also the largest consumers. At the present time, further supply additions from East Africa are projected to hit the market around 2020, 2021, depending on LNG demand from India and Thailand, which are where the contracts are likely to be placed. Note that final investment decisions over the next 24 months will determine the amount of incremental LNG supplies available due to the lead time of these projects around the turn of the next decade, 2020, 21, 2022. OECD Asia in blue, namely Australia, New Zealand, Israel, and Japan again, are projected to grow their supply threefold from 47 BCM to 170 BCM by 2020, with half of this growth in the five-year period now, 2015 to 2020. And by the way, Australia is expected to outpace Qatar as largest exporter in the world for LNG when all of their projects that have been in the works for many years coming online. Non-OECD Asia green, natural gas supply peaked in 2010 with only modest gains projected. Significant CapEx spend and accelerated project sanctions, however, could alter this. Much of Malaysia's production stability is being delivered through FLNG units. That's a key opportunity on our landscape, or floating LNG, and we'll talk a bit more about that later. We certainly have a lot of data on it. Malaysia is using that to monetize stranded gas there with some success. Excuse me. Within the region, excluding China, Malaysia and Indonesia will represent a majority of the region's supply, but modern production growth from India and Thailand will lead the region to become a net importer, perhaps, according to the IEA, at 2020. Lastly, Middle East production in dark gray is expected to triple from 2000 over the forecast period, with 34% of that growth in the last 10 years, 2010 to 2020. Now back to Earth. Most of our project costs have grown economic in the current climate. I'm sure many of us are facing this firsthand. The source of this slide is BP Spencer Dale in a report he published in October on new economics of oil. And this is really just a very simple, straightforward slide. It doesn't have a lot of detail, but the point of it is this. As we are aware, offshore and deep water must be competitive on a global basis with other energy sources. Deep water and offshore are shown in amber, towards the middle to the right. As you can see, they're a little bit to the right of the middle of the cost spectrum, as illustrated, certainly higher than the Middle East from left to right, onshore, other conventional. But on the right, far right, Canadian tar sands in the Arctic still are, generally speaking, more expensive than offshore and deep water. Now, projects are run and developed across all spectrums of cost relative to break-even, dollars per barrel, and all the rest, but this is just a general illustration of where we are. One thing about offshore and deep water, let's not forget that the big projects most likely to be developed and that have been developed offer scale, high impact, comprising fields with generally larger reservoirs, high production rates over long periods of time, 20, 30, 40 years. You do not see these types of wells onshore in the shale. So we're talking about a different type of reservoirs. At the same time, a renewed push to marginal subsea tiebacks in select regions globally is being observed. As I mentioned earlier, subsea boosting, gas compression, subsea pumping, they also call it, like the Jack St. Malo field in its later phases, help boost the production rates and assist with the economics of these fields. And that we call these brownfield opportunities. This is talking about the changing economics of projects. And here again is another simple illustration. Shown are the key building blocks and the related costs of a typical deepwater project. If you look at the gray, SPS, subsea production system, and SURF contracts, they're roughly, again, roughly round numbers, 30% of the cost of a project. Whereas fabrication is around 30%, let's say, and then drilling, both exploration and development activities from floating ridge is expensive. It's 40% of a typical project. That number used to be higher. Deflation is amongst us and is squeezing select cost elements, including lower costs for raw materials, which can be a positive, and other finished goods. Other cost drivers are, as an industry, what we're doing now to combat some of this cost are early engagement for project feeds so we can get the designs, optimal designs and studies for the best development methods. In addition to potential efficiencies gained at the interface of large work scopes, such as between subsea equipment supply and the marine contractors' packages of the installation activities of all the same. Do you think it is possible to achieve project cost reductions in the region of 25 to 30%? While you ponder your answer, let me offer the following simple illustration. This will likely require a step change of the way as an industry we approach projects. We're in the middle of all this, or really at the early stages of all this right now. As shown in round numbers, a 30% reduction in the SPS SURF components could drive a net 9% cost savings to the project. Similarly, a 25% decrease in fabrication could yield about a 7.5% savings net to the project. Again, this is a simple illustration of what could be done. These aren't exact, or it may not work this way. Meanwhile, declining day rates for floating drilling units are leading potential project cost reductions. A 50% decline in drilling could shave 20% or more off total project costs, and that's a number that we should get excited about. In the current cost environment, we are starting to see a trend, most recently, towards a smaller swath of phased projects. Some examples of these are Chevron Buckskin here in the Gulf of Mexico, which originally was looked at as a 4-drill center project with a standalone, and now they're looking at a 1-drill center subsea tieback with phases. Other projects are the fast track of ExxonMobil's Liza, which is the floating production system in Guyana, of all places. We'll talk about that momentarily. And also another example is BP Cascada in the Gulf of Mexico, from what we hear. The goal of these phase concept developments is to offer right-sized facilities, ideally with shorter execution schedules, allowing for enhanced net present value from the earlier first oil and gas production. This is what drives the economics, as you know. Now on to a little bit more about deepwater drilling, left to right of the donuts. As shown, total ultra-deepwater supply from floating rigs has grown exponentially from 67 units, the supply in 2009, to 134 in 2012, and presently, this year, is at 176 units. However, coupled with lower demand, this has led to utilization rates below 80% this year for the ultra-deepwater capable rigs. With the fleet distribution, far right donut, 2015, blue, 35% here in the Gulf of Mexico. Note, one slide left, in 2012, the largest fleet distribution was Brazil, and this has certainly gone down. Currently, Brazil is about 23%, Africa about 22%, and the non-Golden Triangle regions rounded out the balance at about 20, shown there in purple. Current rig oversupply has led to the following fleet attrition and acceleration of stacking. As shown, the cumulative number at the right is 120. That's how many rigs have been stacked over this time period, with the drastic acceleration starting in 2014 and continuing this year, which has experienced a near doubling of the stacking of units. Some of these are permanently stacked, as shown in the pie, some scrapped in green, and cold stacked in maroon, not likely to come back. The warm stacked units are the ones likely to come back into service where is appropriate. This is a slide, an illustration of the floating drilling rig day rates, and a look at the average day rate trends over the past 8 years. It certainly reveals cyclicality. An analysis by rig water depth rating has shown midwater in gray, deep water in orange, and ultra deep water in blue. Initial day rate peaks are shown at 500,000 to 600,000 a day in 2008, followed by a trough in 2010, leading to a reduction of 25 to 35% in day rates from the global financial crisis in 10 and the moratoria on deepwater Gulf of Mexico drilling. We did come back in 2013 and made a new high, followed fairly quickly by the current trough, where rates are largely back to where they were in 2007, is again generally round numbers, down as much as 40% from the recent highs. Obviously, we look at day rate contracts on a weekly basis, and leading edge day rates obviously show more dramatic swings than this. Continuing with drilling, looking at exploration and appraisal activity, global exploration has taken a nosedive this year, and expectations for even lower levels next year, the inflection point, we believe. Hopefully, we'll be out of it in 2017 with a rebound, perhaps late 16, but certainly 17 and 18 for global exploration. Exploration spend, based on our observations, have been the most elastic relative to the operators cutting that spending. Some bright spots. This red line, plotted to the right axis, is actually the percentage of what we call frontier exploration, which peaked in 2013, and that's the percentage of the activity that's going on. And right now, it's at about 17%. We've had a recent fall off in exploration relative to what I've mentioned earlier, and generally there's more risk in frontier exploration. This is just an illustration of frontier area drilling. It's not meant to be read in detail, but it shows generally highlights of currently drilling projects in yellow, planned drilling projects in red, and projected projects for drilling, frontier drilling that is, the next 1 to 2 years. What really amazes me by this is how widespread it is across all the continents for the most part, certainly not the west coast of the US or the east coast of the US, but in other areas you can see lots of activity. Total well demand. We provide total well demand data to the likes of Schlumberger, Baker Hughes, Halliburton, GE, Drillquip, the operators, and lots of others, because wells matter. Wells, it's what we're all about, most of us here. We're ultimately developing and constructing wells at the end of the day, or the equipment that supports those activities. Over the last period, 2010 to 2014, the peak periods of drilling offshore from floaters, over 3,000 wells were spud globally. The exploration activity is highlighted in blue. However, now we've thrown in development wells, which are the wells that are producing or will produce, and those are shown here in green. Large exploration campaigns in Brazil, Australia, and Norway have now shifted largely into the development phases. The pace of growth in exploration in higher cost regions such as West and East Africa near term have slowed. From 2015 to 2019, we project a 25% decrease in total well demand relative to the previous comparable period. A shift towards development drilling in green has affected the mix. Now on to activity trends for floating facilities, the platforms, principally floating ones, and we're looking here at a 5-year comparison, so history plus the current forecast period. Although we project greenfield project executions to decrease 24% sequentially, as shown, over the 5-year forecast period. Quest expects the volume of subsea tree awards to rise as much as 15% in the forecast period, and we'll look into the regional mix of these projects momentarily. This is Quest's take on greenfield project sanctions by year over time through 2025, which is subject and will change the next time I give the presentation, rest assured. As you can see, we're in a multi-year trough of projects in the 14, 15, 16 period. Year to date, we've seen around 8 deepwater project executions, most in Africa, plus Shell's Appomattox here in the Gulf. If we look at the projected rhythm of project sanctions executions, there is hope, however, for acceleration, although that is not likely to be ignited until 2017. This could change. Natural gas infrastructure projects, both shallow water and deep water, may be a cornerstone for growth, we believe, if we look at the sizable project opportunities these field developments bring. And now quickly into the regional forecast, and then we'll have at least 10 to 15 minutes for Q&A. Asia Pacific is a latecomer specifically to the subsea game with a small but respectable active installed base exceeding 400 wells. The key areas are Australia, India, Malaysia, and Indonesia. If we look at leading indicators for sanctions and awards, as shown, we're looking at flat levels of activity, but it's still there over the forecast period. If we look at subsea awards, Australia is leading the activity, with a near doubling of awards over the forecast period. It is coming back. It was pretty quiet for a couple of years most recently. And then outside of Australia and Asia Pacific, it's about a 15% increase in subsea activity. If we look at pipelines, these are side-by-side bars. The left series is history and the right series is forecast. We'll show a few more of these for different regions going forward. They're stacked as follows. The bottom stacks or one specific region, and then the top stack is another specific region. So the left series is pipelines that are 0 to 14-inch OD, typically referred to as infield flow lines and subsea production flow lines. The right bar of each series are the export lines over 14-inch OD. These typically delineate infrastructure projects, transportation and transmission projects all around the world, as well as exports to other facilities, existing pipelines, or to shore, depending on the field selection development. Offshore pipeline growth is most notable to grow in Australia in the 0 to 14-inch category, shown in the lightest purple in the forecast series to the right, but the left bar. With respect to standalone developments in Asia, these are just referenced for projects currently in queue, so we define those at the status, the stage gate of concept, feed, or bidding. So these are not all the projects in the universe, but these are the ones near term that are likely to be designed and built and executed over the current forecast period for startup, either in this period or a little bit after. And these series of slides for each region are all plotted the same. Asia Pacific has a steady forecast of standalones, as you can see, led from Australia and Indonesia. Subsea tiebacks, meanwhile, are distributed predominantly amongst Australia, Indonesia, and India. And note, 70% of these are in conventional water depths, as shown in the pie, 0 to 1,000 feet. Asia Pacific traditionally has been a shallower water region, although there's some deep water activity there. If we look at Africa, Quest projects steady spending levels as shown for subsea systems off Africa and related hardware of around 2.4 to 2.9 billion per year, representing an average volume of over 80 wells per annum. It's one of the more active areas. Africa's installed base of wells exceeds 1,100, that's subsea wells, and now the largest region of subsea activity behind the North Sea, which has been active a long time, and close to Brazil. Total and ExxonMobil, respectively, are the largest operators of subsea wells in the region, with BP and Chevron the next most active. With the acquisition of British Gas, Shell will rank between BP and Chevron as with respect to total number of wells operated in the region. These days, all of Africa is important. Once upon a time, it was mostly West Africa. But now the Mediterranean, North Africa, and Egypt is about to fast-track a project for its natural gas consumption. Eni is driving that project, and it may be awarding in the next 1 to 2 years. Key areas are East Africa, Israel, Egypt, Equatorial Guinea, Ghana, Angola, and Nigeria. Last week, in fact, there was an interesting discovery by LAGCOE named Lyra in the Black Sea off Romania in 700 meters of water at a drilling depth close to 2,700 meters. As shown, West Africa executions are expected to be flat with the projects, the lower bars, but the growth coming from North and East Africa subsea awards, 15%. Pipeline awards are flat, but note exports greater than 14-inch OD, which is the far maroon line to the far bar to the right of the bottom there, is expected to grow threefold. Looking at standalones, Africa Mediterranean has a steady forecast of standalone projects led from Angola in orange, Mozambique in amber, and Nigeria in blue. Subsea tiebacks, meanwhile, these again are the projects that are in stage concept, FEED, or bidding, not the whole universe of projects. In a couple of years, some more of those projects will come along. The subsea tiebacks are distributed predominantly amongst Ghana, Angola, Egypt, and Mozambique. I had a couple illustrations on Brazil and Gulf of Mexico, but I think at this point we'll probably stop for Q&A.
You've got us turned on. Well, obviously, Paul knows a lot about data. He's thrown so much data at me sitting here, my head's kind of spinning as to what really is out there. And I guess kind of in summary, and this is kind of what I've heard, and hopefully it'll create some questions for you, because I know I have a lot of questions if you don't have any. We're going to open it to the floor in just a minute. But in summary, I think we talked about an evolving landscape. We see some growth in natural gas on a global basis. There's certainly a change in cost structure. I think many of us who are in the service industry are feeling that right now. And of course, the operators, hopefully, are taking advantage of that for future net savings, as you mentioned. The interesting thing is, and I think there's a big debate over recovery, 2017, 2018 on drilling, but then again, we have, all of the fabrication and installation needs to take place and finally production, which, gives me some concern when we talk about such late recovery. The LNG floating, programs appear to be somewhat declining, I think is what you said. I may be off on that one.
Yeah,
but
what we're seeing now is different sizes of LNG. They're not just the large projects like Wheatstone and Sunrise for Shell, and there are two underway in Malaysia. But there's more. We're tracking some other projects, really like floating storage and regasification units, which are definitely not FLNG, but they're associated with gas, where it gives you the flexibility to either import or export the gas, depending on what you want to do.
Good. First, let me say that I've invited. Actually, it was pretty spontaneous. David Baker, who's with University of Louisiana, of course, charged with international, is an international professor there, but I've asked him to join me too because I needed another set of eyes to look at all these statistics, and of course he can grade Paul here when he's done. We'll give him some sort of grade.
Can I get an honorary diploma, maybe? That'd be great.
We might be able to do that too.
I'm not saying it was that good.
Anything's possible. But David, I don't know if you have a question or two. We could probably start with you and then open it to the floor.
Well, from my viewpoint, it like on some of the data, I noticed it appeared there was a 200 BCM increase in production in North America by 2020. Where's this going to come from?
Is that from the IEA data?
I believe so.
That's
yeah.
onshore and offshore activity. That's all of North America production.
Okay. And then you project some growth, you project the total well demand growth from 2017 to 2020. Can you explain a little more what the underlying basis for that projection is and where's that demand going to be located?
Yes. That is total well demand, so it's not only the inflection point that we're moving from 2016 into growth for exploration only. So 2017, 2018, we see this larger supply of lower cost drilling rigs going back to work all around the world for exploration. We have all the detail. It's pretty well spread. It's certainly active in Africa. The Gulf is expected to maintain its activity. We haven't lost too many rigs there. And then on the development side, it's the projects, either long phase projects, like Total Angola has a project currently underway. Some of that development will continue because it's a 67-well project. So the balance of it is development demand increasing, so both increasing, in a couple of years moving forward.
Okay.
And those are still below, unfortunately, they're still below record levels, but this is kind of our mean case. I mean, there's an upside and kind of a downside to it.
Okay. I only had one other question, and it was more from a general perspective on the shifting contracting model. Can you give some examples or some implications for companies where that moving from the older model to the shifting contracting model?
Yeah, we haven't looked into a lot of detail on that because it's currently evolving, and some companies are pitching different things. The one that's kind of on the front edge which is still being discussed, but it's what Schlumberger is mentioning, where they're looking at more pay for performance. And I guess as an industry, we may have tried that before, and I'm sure we have some ideas about it. We see the same kind of reactions when we talk about standardization because we know how hard that can be. In the current climate, we think we're going to actually have to change the way we're doing some things to survive and or prosper. So a lot of the buzzwords are actually coming back into really rolling up our sleeves and having to really address some of these issues. As far as the commercial model, what we can see is some of the collaborations that have been set up, for example, in the marine contracting world and the project builders and executors. You have FMC, FTI, which is a large subsea supplier, and you have Technip, which actually acquired Global years ago, and they're a large marine contractor as well as fabricator all over the world. They've aligned in a collaboration called Forces, and their idea is to get in early and with a holistic approach, look at all the designs and moving parts of a project, and knowing that they're going to build and install, or they hope to, most of it, looking at the efficiencies that can be gained by, looking at everything at the early phases. Mm-hmm. And that's difficult to do. Some operators seem to be more keen on it and others don't. So I think that's very early stages. They have an office in London at the Technip Genesis headquarters across from St. Paul's Cathedral. And there's other similar ventures. One Subsea is working on one. You have McDermott and GE called IO. That's office out of the Shard, which they say is inexpensive real estate because it's the 10th floor. I don't know, but I know the rest of it isn't.
Thank you.
Yeah, thanks, Paul. We have, again, we have some volunteers actually from the University of Louisiana who are students that are under David, and they volunteered to assist us. They have a microphone available in the back, so if you kindly just raise your hand, they'll get a microphone over to you so you can ask your question of Paul. Yes, sir? There's a microphone coming your way.
My name is Arun Karle.
Hello.
I'm a consultant from India.
Hi.
Very good presentation. I've got one question. Do you have a data on the price of gas in different places around the world? And how does that get changed? For example, in India, we import LNG
Right.
between $10 to $16 per million BTU, but we give only $4 to the folks who are producing over there.
Right.
So
we don't have a database on the pricing, but I would suggest Bloomberg or some other sources for that. But we see, some people are thinking that India will likely place contracts longer term for some of that East Africa natural gas in Mozambique, that Eni has a project that's likely to go, and then the Anadarko project is a little more uncertain. But some people are saying that it'll be more cost effective for India to contract that gas than it will be for you to go to Indonesia or Qatar. It's early stages, if that's what some experts are saying. That doesn't answer your price question, I guess. But yes, as the the prices change all over the world, you know, relative to what that model. What is the range? I think the range that you mentioned is certainly one that I've heard.
Any other questions, please? Thank you for your questions, sir. Actually, I still have one. You know, we really didn't talk much about Mexico. We do have a Mexico presentation coming here later today, but there's going to be, I think, driven in a different direction about regulatory reform and stuff like that, I believe. But can you talk some about Mexico? You know, they're our neighbors. They're close. Many of us here are seeking international opportunity because things are slow in the U.S. Gulf of Mexico. What does it look like in Mexico right now with this reform? Is it really going to happen? And are there opportunities for us in this room to gain access to it?
Absolutely. We're real positive on Mexico as well, sitting here in the Americas. In our universe, which tends to be a little more deep water projects and a little more technology oriented, we don't see anything near term. I mean, there's projects in the execution phase right now, and there's 4 floating semis under contract to Pemex drilling wells actively. However, we've seen a slow pace of projects, named project executions come out of that activity. As I said, there's one well-known one underway that has subsea scopes to it as well. We're encouraged by the redefining of round 1, where they came out again with different terms, and you showed more interest from companies. Round 2, I don't know if it's round 2, but the next round that's offered, which goes into a little bit deeper water, was originally mentioned somewhere around the end of this year. I don't know hopefully they'll know what the current timetable of that is. But in short, it's 3 to 4 years away perhaps from, multiple projects in execution phase, aside from the shallow water conventional type stuff. So near term, it's uncertain, but it's very positive relative to changing their constitution and what's going on right now. And hopefully they're out and about getting education and listening and learning from folks about the regulatory regime and not make the same sort of decisions that Petrobras has made. I want to be politically correct on that.
Yeah. I'm glad you gave a little thought to that before you made that answer, but yeah. Because, I think a lot of us, I was formerly with Global Industries. We're a construction company and laid pipelines, did heavy lift and subsea work. And we hurriedly went to Brazil, worked with Petrobras, and, we've learned very quickly it was very challenging. And, of course, now we know what's happening here recently in the news. So I think a lot of us are looking for other safe havens to send our assets and our people. So it's been a challenging market, and it's been interesting to watch. Any other questions that may have just come to mind? There are no silly ones here.
Let me comment on that while we're looking for other questions. I touched on it, but it was probably fairly quickly. But there's some real exciting areas in South America that are not Brazil, like ExxonMobil Guyana. The Anadarko is drilling actively in deepwater blocks in Colombia. Trinidad has deepwater licenses and leases that are actively held. And we haven't seen much from Cuba. Repsol drilled there and really didn't have much success. They're actually cutting back quite a lot globally. They acquired Talisman, but there's a lot of hope for the whole, America's region. With respect to up north, you've Exxon adding additional phases to Hebron off Canada, but you also have a Newfoundland, which is Shell dismobilized a rig a couple of weeks ago, an ice-class drill ship, I believe. It was a semi-air drill ship, to the region to drill. ConocoPhillips has blocks there. Statoil calls it, they've had discoveries in the Flemish Pass off Newfoundland in deeper water. The original developments there were in shallower water. They call it the leading edge of a world-class province, their words. So we'll see. There is starting to heat up a little bit.
Any other questions? Before I close out our sessions, I just want to remind everyone that we do have a great international presence. Paul's talking about other areas of growth. We have Korea that's here that will be presenting. The Ukraine is here in full force. They have a lot to talk about in their area. Mexico, of course, will be here presenting as well. And Saudi Arabia is here. So we've got both Aramco Services will present, and we have various companies working currently in country and in kingdom that will also be here giving some presentations. So if you have any more interest in expanding into international marketplaces, these are going to be some great presentations coming over the next 2 days. Paul, thank you very much for and I have to say a last minute invitation replacing Ali. I think you did a formidable job, and I think it's actually much broader and better information in a single area. Although I know Ali personally, he's a great guy. I think you did a phenomenal job. Thank you for that. You all students, thank you so much for our help. David Baker, of course, the professor from UL, I really appreciate your being here. Everyone, have a great day. We have a wonderful show, great conference ahead. Thank you for your kind attendance today.